Chaos. $600 billion disappeared. In hours. Then surged back. Something broke. $600 billion gone. Not in a crash, not in a war, not overnight. In hours, and then, just as quietly, it came back. The market smiled. The headlines moved on. But something didn't reset. Something that was holding the entire system together broke. And the people who were supposed to tell you, they said nothing. This is what they didn't explain. Welcome to Metal and Macro. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't cancel your newspaper the morning after the biggest story of the year. This channel is that newspaper. Hit subscribe, keep it running, and tell us something. Where in the world are you watching from right now? Drop your city, your country, right there in the comments. Because the people paying attention to what we're about to discuss are watching from everywhere. The morning started like any other. Coffee cups filled, screens lit up. Traders in New York, London, and Hong Kong settled into their chairs, ready for another routine session in what had been, by all appearances, a functioning market. But by midday, something had gone very wrong. It began with a number, a single percentage point. The S&P 500, the most watched financial index on the planet, the one that pension funds, retirement accounts, and trillion-dollar institutions track every single day, dropped 1%. Well, 1% does not sound like much. But in the world of modern finance, 1% of the S&P 500 is not a rounding error. It is $600 billion, gone in hours. Not because of a war, not because of an election, not because of a natural disaster or corporate scandal or a surprise government announcement. The market simply fell. And $600 billion in wealth, money tied to the savings, the retirements, the futures of ordinary people, disappeared from the board. Analysts scrambled for an explanation. Financial news channels filled the airtime with familiar faces offering familiar phrases. Profit-taking, market correction, healthy pullback. The language was calm, measured, designed to prevent alarm. But the people actually sitting inside the trading floors knew something different was happening. Because within hours of that 1% drop, the market pumped back 1.1%. $650 billion returned. Almost as if nothing had happened. Almost as if the entire event had been erased. The headlines relaxed. Social media moved on. The financial commentators declared the session volatile but ultimately unremarkable. They were wrong. What happened that day was not a correction. It was not profit-taking. It was not a healthy market doing what healthy markets do. What the data showed, for those willing to look past the surface, was something far more telling. The Nasdaq told the same story in its own numbers. First, a drop of 1.34%, $536 billion erased. Then a surge of 1.43%, $540 billion returned. Two-way swings of that size, happening within the same session, do not occur in stable systems. They occur when something underneath is breaking. To understand why, one must first understand a simple truth about how modern financial markets actually work. Markets are not purely driven by logic, value, or long-term thinking. They are driven by leverage. Leverage means borrowing. It means a hedge fund with $1 billion of its own capital can place bets worth 10, 20, sometimes 30 billion. As long as the market moves in their direction, the returns are enormous. But when the market moves against them, even slightly, the math turns brutal. Their lenders, the banks, send a message. That message is called a margin call. And a margin call does not ask politely. When a margin call arrives, the fund does not have time to think strategically. It does not ask which asset is overvalued or which sector has weak fundamentals. It asks one question only: what can we sell right now? And the answer is always the same: whatever has buyers. This is why, on that day, assets that had nothing to do with each other, metals, equities, commodities, all moved violently at the same time. Not because their underlying value had changed, but because the funds holding them were forced to sell everything that had a market. This is the signature of forced deleveraging. It is not random. It is not normal. And it is never a good sign. Because forced deleveraging at this scale does not happen in the early stages of a cycle. It happens near the edge. It happens when the borrowing has gone too far, the bets have grown too large, and the system no longer has the cushion to absorb even a modest shock without triggering a chain reaction. That day, the chain reaction started. The markets recovered on paper, but the fracture that caused it remained. There is a moment in every structural failure when the cracks are visible. Not to everyone, not to the headlines, not to the commentators filling airtime with reassuring language and carefully selected charts, but to anyone who has studied how systems collapse. The signs are always there. Quiet at first, then impossible to ignore. That moment arrived on this particular day, and most people missed it completely. Imagine a man standing at the edge of a frozen lake. He has crossed this lake 100 times every winter. Same path, same confidence. The ice has always held, so he walks again, faster this time, heavier than before, and somewhere beneath his feet, a crack forms. He does not hear it. He does not feel it. He keeps walking. That is exactly what had been happening inside the financial system for months before that session ever opened. The leverage had been building quietly. The bets had been growing larger. The borrowed money had been piling higher. And the institutions managing these positions had convinced themselves, as they always do, that the ice would hold. It did not. To understand what broke that day, one must first understand what a hedge fund actually does at its core. A hedge fund is not simply an investment vehicle. It is, in its most honest description, a borrowing machine. It takes capital from wealthy clients and institutions. Then it borrows additional capital, sometimes 5, 10, or 20 times the original amount, and places that combined weight into complex positions across markets around the world. When everything moves in the right direction, the returns are extraordinary. When something moves the wrong way, even slightly, the entire structure becomes fragile. Because the banks that lent the money are not partners in the trade, they are creditors. And creditors have one priority only: getting paid back. This is where the margin call enters the story. A margin call is not a conversation. It is not a negotiation. It is a demand, delivered electronically, automatically, and without sentiment, that says the following: the value of your position has fallen below the required threshold. You must deposit additional funds immediately, or we will liquidate your holdings to recover what we are owed. There is no appeal process. There is no extension of time. The fund must act, and it must act now. So it sells, not what it wants to sell, not what makes strategic sense to sell, not what the analysts would recommend selling after careful consideration of market conditions. It sells whatever has buyers. It sells whatever moves fastest, whatever has the deepest liquidity, whatever can be converted to cash before the clock runs out. This is precisely what the data revealed that day. Assets that had no logical connection to each other moved in perfect unison, downward first, then sharply upward. Equities, metals, commodities, instruments tied to completely different economic stories, different geographies, different fundamentals. All of them hit simultaneously. That kind of synchronized movement does not come from rational analysis. It comes from a single forced seller, or multiple forced sellers, liquidating everything at once simply to survive the margin call. The 1% drop in the S&P was not a market making a judgment about the economy. It was a margin call being answered. The surge that followed was not confidence returning. It was the temporary stabilization after the forced selling stopped, the market bouncing back mechanically once the pressure was released. But here is what the recovery concealed. When a fund is forced to liquidate at that scale, it does not simply regroup and return to normal. The positions are gone. The leverage is reduced. The strategy is disrupted. And the confidence of the lenders, the banks behind the margin calls, has shifted. They begin to tighten, quietly, gradually, but consistently. And when lenders tighten across the system simultaneously, the available credit that has been fueling market activity begins to contract. That contraction does not announce itself. It works in silence. And silence in financial systems is rarely a sign of safety. It is usually the sound of the next crack forming, beneath the surface, beneath the headlines, beneath the recovery that everyone celebrated a little too quickly. The mechanism had revealed itself that day. The question was no longer whether something had broken. The question was how deep the fracture actually ran. There's an old technique used by structural engineers. When they want to understand the true condition of a building, they do not look at the walls, they do not examine the paint, they do not measure the windows or inspect the lobby. They go to the foundation, because the foundation never lies. Whatever the surface shows, stability, strength, normalcy, the foundation tells the real story. Every stress, every weakness, every crack that formed long before anyone thought to look. On that day, someone looked at the foundation. And what they found was not reassuring. While the mainstream narrative focused on the surface, the dramatic drop, the miraculous recovery, the volatile but ultimately manageable session, something far more significant was happening in the deeper layers of the financial system. Something that rarely makes headlines. Something that most business journalists are either not trained to explain or quietly choose to avoid. It was happening in the repo market. Most people have never heard of the repo market. That is not an accident. The repo market is the financial system's plumbing. It is where banks, institutions, and governments go to borrow money overnight, sometimes for just hours, using their existing assets as collateral. Treasury bonds, mortgage securities, high-grade financial instruments pledged in exchange for short-term cash. On a normal day, this market functions invisibly. Money flows in, money flows out. Rates stay stable. Nobody talks about it because there's nothing to talk about. But when the repo market shows stress, it means the banks themselves are struggling to find liquidity. And on this particular day, the repo market was showing stress. The Federal Reserve, the central bank of the United States, had been quietly monitoring these signals for weeks, behind closed doors, away from press conferences, away from the carefully worded statements designed to maintain public confidence in the system. Because the Fed understands something that very few ordinary observers appreciate. The repo market is not just plumbing, it is the early warning system of the entire financial structure. When banks begin struggling to fund themselves overnight, when the rates they charge each other for short-term borrowing begin to spike, it signals that trust between institutions is breaking down, that liquidity is tightening, that the cushions built to absorb shocks are thinner than the official reports suggest. This is not theory. This has happened before. In 2008, the repo market froze before Lehman Brothers collapsed. In 2019, it spiked so violently that the Fed was forced to inject hundreds of billions of dollars in emergency liquidity almost overnight. History does not always repeat, but it has a habit of rhyming. Now consider what else was happening beneath the surface on that same day. While equities were swinging violently, and while margin calls were being answered, while the repo market was quietly flashing yellow, the metals market was telling a completely different story. Silver in Western markets sat at $73, but silver in Shanghai, the Eastern physical market, was trading at $86, a $13 premium, holding firm, even as Western paper prices compressed violently downward. This divergence is not a minor technical detail. It is a fundamental signal. In a healthy, functioning global market, prices for the same asset do not vary by $13 between East and West. Arbitrage, the process by which traders buy cheap in one market and sell expensive in another, closes those gaps almost automatically. When the gap refuses to close, it means the arbitrage is not working. It means physical metal is not moving freely between markets. It means the paper contracts being traded in Western exchanges are increasingly disconnected from the actual physical reality of supply and demand. And when paper and physical diverge at this scale, the paper is not telling the truth. Gold told the same story. Western spot prices falling below $4,900. Physical demand from Eastern institutions quietly accelerating. The mainstream financial media declaring the metals bull market finished, pointing to the 40% correction from highs as proof that the trade was over. But the physical market disagreed, because physical buyers do not trade on headlines. They trade on what they believe the paper will eventually be forced to admit. And here lies the deepest fracture of all. Not the margin calls, not the repo stress, not even the violent intraday swings that erased and restored $600 billion in a single session. The deepest fracture is the growing distance between what the official numbers say and what the underlying reality shows, between what the paper claims to represent and what the physical market is actually doing, between the surface of the building and the foundation beneath it. The engineers who looked that day did not find a stable structure with minor surface damage. They found a foundation that had been quietly absorbing stress for far longer than anyone had officially acknowledged. And foundations do not crack gradually forever. At some point, they give way completely. There is a particular kind of silence that falls over a room when the people who are supposed to have answers realize they do not. It is not the silence of calm. It is not the silence of confidence. It is the silence of people who have finally understood the scale of what they are looking at and are carefully choosing their next words. That silence existed in certain boardrooms and private offices on that day. The question now is whether the people outside those rooms are paying attention. History has a consistent and uncomfortable pattern. Every major financial disruption, without exception, was preceded by a period in which the warning signals were visible, documented, and available to anyone willing to look. The 2008 collapse did not arrive without warning. The mortgage delinquencies were rising months before the headlines acknowledged the crisis. The repo stress was measurable. The leverage inside the banking system was documented in quarterly filings that almost nobody read. The warnings were there. Most people simply chose the comfort of the official narrative over the discipline of independent analysis. That choice cost them enormously. So what should serious decision makers, business owners, entrepreneurs, investors, and anyone responsible for capital actually do with what the data is currently showing? The answer begins not with action, but with understanding. Because the single most dangerous position any decision maker can occupy right now is not being fully invested in a declining market. It is not holding too much cash in an inflationary environment. It is not even being exposed to the wrong assets at the wrong time. The most dangerous position is being uninformed while believing otherwise. The first thing serious decision makers must understand is the nature of what was witnessed that day. This was not volatility in the traditional sense. Volatility implies randomness, markets moving unpredictably because participants disagree about value. What happened was structural. The swings were not the result of disagreement. They were the result of forced action. Institutions selling not because they wanted to, but because the system left them no choice. When markets move because participants are forced rather than willing, The normal rules of analysis stop applying. Value stops mattering in the short term. Fundamentals become temporarily irrelevant. And the rational long-term thesis that looked compelling on a spreadsheet gets destroyed by the mechanical reality of a margin call that must be answered in hours. This means that any business or investment strategy built entirely on the assumption of rational, orderly markets is currently operating on a flawed foundation. The second thing serious decision makers must understand is the significance of the east-west divergence in physical assets. That $13 premium between Western and Eastern silver prices is not a curiosity. It is a message. It is the physical market communicating that it does not trust the paper price. That the paper price, driven by leveraged trading, derivatives, and financial instruments that exist only on screens, has drifted too far from the underlying reality of actual supply and actual demand. When physical and paper diverge at this scale, one of two things eventually happens. Either the paper price rises to meet the physical reality, or the physical market tightens so severely that the paper contracts become impossible to honor. Neither outcome is neutral. Both outcomes carry significant implications for anyone holding either paper assets or physical commodities as part of their strategy. The decision maker who understands this divergence in advance is in a fundamentally different position than the one who discovers it afterward. The third thing serious decision makers must understand is perhaps the most important of all. Liquidity is not permanent. This sounds obvious, but the behavior of markets over the past decade, driven by historically low interest rates, aggressive central bank intervention, and an almost uninterrupted flow of cheap credit, has conditioned an entire generation of business owners and investors to treat liquidity as a constant. It is not. Liquidity is a condition, and conditions change when the repo market shows stress, when forced deleveraging occurs at scale, when the Fed begins quietly intervening behind the scenes while public statements maintain a tone of calm confidence. Liquidity is in the process of changing. The businesses and portfolios built to survive only in conditions of abundant liquidity are the most exposed when that liquidity begins to contract. So what does preparation actually look like in practical terms? It looks like understanding the difference between paper wealth and real assets, between what a screen shows and what can actually be held, transferred, or converted in a disrupted market. It looks like stress testing capital positions against scenarios that feel unlikely today, because the events of that single session demonstrated that unlikely scenarios can materialize and resolve within hours, leaving permanent structural damage beneath a surface that appears recovered. It looks like watching the signals that matter: repo rates, physical premiums, institutional deleveraging patterns, rather than the headlines designed to maintain confidence in a system that is quietly under strain. And above all, it looks like making decisions from a position of clear understanding rather than comfortable assumption. The $600 billion that disappeared that day came back on the screen. The numbers recovered. The chart stabilized. The narrative moved on. But the fracture in the foundation that caused it did not heal itself overnight. It remained quiet, patient, waiting for the next moment of stress to reveal exactly how deep it runs. The engineers who study foundations understand one final truth: a crack that is ignored does not stay the same size. The decision makers who understand this now will not be surprised by what comes next. The ones who don't will be.